All right. Welcome everyone to the strategy of the week and year end in review here for December 30th, 2021. I'm Dan Hussey from Zaner Ag Hedge. Remember, trading futures involves risk and is not suitable for all investors. And everything we talk about here today is just my own opinion and not a direct trade recommendation. So I want to begin, I guess, where it kind of makes the most sense here. We'll take a look at the March corn contract over the last year. We've seen the market, we've obviously seen the market break through some amazing levels and actually retrace back down through some here. Trying to get this to what I want to show. There we go. So we started off the year, last January, with an open around the 440.5 area. We then ran up to contract highs of around 640.5, in June. So that first 6 months of the year was a pretty staggering, $2 uptrend. And then from January through May, there were a few pullbacks of note that, today's price action and the sell-off we've seen after the nice rally. Well, this can all just be part of, an otherwise larger uptrend as we've seen in the past. And in fact, last year, just after the new year, we got a bit of a pullback in that January timeframe. So happening a little bit earlier right now than maybe it did last year, but the trend is also slightly different. We're starting from different levels and what have you, but more or less, March corn, even back then, right? We had a pullback of from 470 down to call it 431. So a 40-cent dip off of highs before, still trading higher still through March, up to a test of basically $5. A similar, price action might be occurring, and this all might be, in response to trying to break out of this otherwise larger consolidation area that we went through once we hit our August or May high for corn. We pulled back into consolidation for the next 6-month period or so, and now we're starting a trend of another 6-month cycle, if that's what we're doing here. Coming out of harvest time frame and going into pricing into next year's crop. Some major levels were broken through. We had trendline resistance. Kind of really, no matter how you draw this against these highs, we've broken through it every way you can. And now even the last way you really could draw this trend line from the original high through that high in June, through the high we had here in November, we finally broke through it here over the last week. We've now tested back to trade it as support. So that's broken trend line, resistance now as support, and what could otherwise be, referred to as, an uptrend, and a breakout setup occurring here. The 18-day moving average coming in at 596. We came down to test that here today, held that. That was pretty good. The 100-day moving average is still below us, down around 561. 55-day there at 576, and the 200-day been untouched since last October, down at 556. But this corn chart does seem to me look like it wants to be breaking out, and that is, of course, if it holds from, wow, what is this? What's going on here? Either way, let's break down the smaller time frame and take a look at what maybe the 4-hour chart here did in the near term. So we've had a pullback now, right? 617 highs down to 592s. That's a significant move for corn. 3 waves down. First leg here from the 617 highs down to the 599 lows. Extend it from the 610 high. 592 is at equal legs with 100% extension. 3 waves down into 50% retracements from our swing, or really, if you want to just do the 50% retracement from the low of the month here at 567 through the highs of the month, was also at 592. So pretty technical pullback for corn, all things considered. Like we talked about, we're hitting that larger trend line resistance now as support, and we've got other trend lines through the lows that come up and have confluence through this area. So this 590 2 to 5, let's just call it 88 area, this 590 figure seems like an important level now for the market to hold above. And again, that's old resistance, not only trend line, but proven here in October or in November, late November and mid-November, that we finally broke out of. testing it now as support. If we hold and continue higher, that's what's going to, continue this trend for now. We break below, these levels, we could very well see a substantially bigger correction. But for right now, I think we're down into supportive areas that we can potentially look for maybe some support here, which, that brings me to, okay, how do we reposition now, for corn? Let's say at this point, we've been talking with clients and wanting to be anywhere, anywhere in the 25 to 40% sold for new crop. What can we do for reownership? And certainly if you're holding on to on bushels from last year, um, we we think that it's prudent to make a move on those while we're moving above, and every time we rally above 6 and continue to press higher, because on pullbacks like this we can come in and do reownership on the board. And that's what, a day like today, where we're 20 some odd cents off the highs at one point here, and settled 22 cents off the highs. It gives us the opportunity to trade the futures and do so with sometimes limited risk and options. Um, that's where I think today there might be an opportunity for corn here going out through. You could go through the March timeframe here. It's a little more aggressive, but given that the 620 call would be the first option that would go in the money above our new highs, that seems like a logical place to start. If you want to spend a couple more pennies for 4 more cents, you can get that 610 call. That was, where we were yesterday in price action. And I would do all of this by turning around and, potentially, selling. You're spending 14 cents for that 610 call. Why not turn around and take, I was hoping to get maybe 5 cents to sell something 50 cents out, but 4 cents off isn't bad for a 10-cent cost to have a 50-cent spread here on corn, that says we'll go above 6, but stay below 660. Again, this is how are we going to get limited risk. Now, in a market like this, though, I would come in and potentially use futures. Okay, looking at a February on March put. Okay. The 585 puts, which would invalidate how much risk I want to have on the table, cost 8 cents. It's a little bit more than I'd want for them. Maybe I don't, you know what? I don't feel like if I'm that aggressive with it, because what I'm trying to set up here is if I go long, if I was thinking about going long futures here, at this 50% level, let's call it, 595, let's call it a fill here. If you were to be a buyer where we settled, I'd only want to risk to maybe 585, right? Because if we start to break trend lines, break below the 618 line, like I need to define a reason to be out. I'd hate to see the market go down there because we could be retracing this entire swing at this point. But for all intents and purposes, I'd want to be out somewhere certainly before 585, because if we go there, we could be, what's stopping us from going another 20 cents lower and being in a larger range that we didn't foresee. So what I'm trying to think through is if I bought a future here at 595, what type of option could I use to offset my risk? 45s give me 10-cent risk from strike to entry point in the futures, plus an 8.5-cent cost to buy them. So that's still 20 cents of risk. I might as well just put a stop in 10 cents below. But do I need 22 days on an option here? Maybe not. So going down to an option that actually expires, in a week, if this pullback is going to be done in the first week of January, geez, come on, is going to end up bouncing back, and by the end of the week we're going to be higher. Now a 585 put cost me 3 cents. That's starting to be a little bit more reasonable in terms of having 13 cents all day risk on buying corn here, with a stop that puts a stop in the market a week out at totally at 13 cents of risk, and that gets gets us through this weekend, gets us through the first. And if this pullback we're seeing on corn in the very short term, if we're into support here and now, like we very likely could be in a technical perspective, it's a setup that, okay, it's a way of having a stop in the market, and for 3.375 cents cost to own that 585 week 1 January put, as your protection ends up, in my opinion, giving you one of those ways you can't get taken out of a trade unless you're really wrong about it, right? Because there's no way of getting stopped and, and some just whipsaw price action um, before that happens. So, all right, well, let's move on here because we got a lot more to talk about, and actually, we're going to end the session with an idea in the hogs, in the February hogs. That's kind of an interesting one. It's a more complex option strategy that I need some time to explain, but it's designed, and we'll get to it later. But it's designed for to potentially capitalize on both sideways price action or a major move to the upside from here. So with that being said, March soybeans now began the year here 1096. Incredible year for the soybeans when you really get down to it. Started the year at 1096. Have had several, 5 substantial pullbacks before making contract highs in June of 1445 and a half. And so from Jan to June, there were 2 pullbacks of 50 plus cents. There were 2 pullbacks of $1, which you can see here on this chart. Sorry, let me pull up the right chart for us. There we go. 2 pullbacks of $1 here, a couple pullbacks of 50 cents, and a pullback of about, what did I say, measure this one as 35 cents here. So right around January, again, we had a big dollar pullback. So seeing some volatility right around this time of year after, that first run up from December, right? The start of December here through January, we had a big run up, okay, so there's a couple pullbacks in there. Well, we're starting to find these cycles, and we're finding them, higher too. So I do expect potentially the market to come down and meet that 18-day moving average, which is crossing above $13 now. I mean, we just had such a volatile move to the upside. Seeing a big retracement is not shocking. The 200-day moving average right there at $13 too. That's pretty awesome to see that we're well above that level now. Certainly, probably would be support on another move down. 100-day moving average down there at 1267, and then 55-day down at 1267, on the 100-day down at 1282. I'd expect those to now travel, turning back up northwards, sending them up towards and above $13 would really start to constitute the breakout higher. And like corn, soybeans have broken out of some really big levels here. Trend lines against the highs have given way every place you can draw them. If I could draw them on the chart, but you can imagine the line here through the highs. Try it one more time for us. Okay, whatever. That we broke out of, and really broke out of with some velocity. I doubt we come all the way down to test that broken trend line as support. It's just not kind of what Beans does when it gets a really, really big move. But it certainly could. I'd expect some other more aggressive levels to hold, which we're going to look at right now. So on that 4-hour chart for soybeans, we could be back into the most aggressive supportive level that I see on the chart. And that's if you draw, and there's 2 ways of drawing this, either from the 1305 high to high, a 50% retracement is back into 1342, or down here at this original 50% off the swing from the month, which comes in at 1331. And I'll tell you kind of why I favor that a little bit here, and I'll give you a hint. It has to do with this little bit of an open gap we'll look at here in a second. But we also have this kind of trend line support that we're holding against the lows that comes in here. This would also be, a channel support here at this point in time for the soybeans, and a good level for the market to hold if it's going to, continue to trend higher, so to speak. But drawing down into smaller time frame, let's look at the 15-minute chart here. Drawing down to that smaller time frame, this open gap on the chart, we closed a biscuit pause. So it was an intraday gap. I don't know how you'd call this, but the biscuit paused at 1331. We actually then opened higher at 1333 and never traded back to that close. I mean, sure, there was that little bit of a back and fill there, but kind of an interesting little area in the market where I guess this candle might have filled it. But I remember having that on the chart and went back to look at it again here kind of my eye caught that little bit of missing price action and wondered if we weren't going down to fill that area. Certainly, it's an impressive area in a chart that we just started a major move from. So coming back down to test it, as supportive down around 1330 is not unheard of, right? We ran from 1330 to 1384 in a day and a half, pulling back over 3-4 days over that same time frame is kind of a win for the bulls because we still have an entire $1.60 worth of rally here to we'd have to chew through. So that being said, 1, 2, 3, 4. This definitely, well, to me, potentially could be a 3-wave move if this was the first wave down here. Second wave was kind of this day of correction, and this is the third wave down. But I'm a little fearful we might see a bounce and yet another push lower. But this extension lower from and breakdown from 1350. 1350 through drawn from lows to lows, this extension short or is 50% short, anchoring here at 1355 down through lows. If we start to break above 1347 and invalidate that, because we're coming into this larger supportive area, that's what I would look for for a short-term break. There's now trend lines against the highs. There's other technical indicators in the short term to look for short-term reversals from. And into tonight's price action, I'm not catching a falling knife just yet, but I certainly would want to be interested in being a buyer here if we get that opportunity from the soybeans. And soybeans are also a chart and an opportunity or a market where I think there could be some option opportunities. Here, I would, if I was buying futures around this area, around into that 1331, 1332. I'm not so certain I would use a stop or a put option as a stop, but we're going to look there first as your first kind of idea. Again, this will have 1 week left on it, this put option, and this is to be used. And I mean, I guess you could use it to protect anything for the next week of price action. But the idea here is that we're trying to spend as little as we can. Spend as little as we can on time value, but still getting the protection. Okay, if we only wanted to risk 10 cents and strike, well, the 1320 strike here is going for 7.25 cents. So for 17 cents of risk from being a buyer, well, maybe a little bit more, call it 20 cents of risk from being a buyer around 1332 in the futures, buying the 1320 put here for 7.25 cents, which might actually be a little bit more expensive if we head down a couple more pennies. But the point being is that, okay, for 20 to 25 cents, you can still buy an option that would give you protection down to those levels, or just use a stop outright. Because if we go below, 1320 here, what's stopping us, in my opinion, from getting $13 or 12.90 or 12.80? There isn't much there either. So I think we're coming into a level that we really want to see hold here as support. And I think that might also, though, give us opportunities to look further out. Reownership through the May timeframe now makes sense. May beans trading at 13.48 here to end of day at a 10-cent premium to the March. Okay, so there's still 10 cents a carry there. That's probably going to evaporate. We're in a market that's starting to turn inverted and trade like an inverted, a non-carry market. But that doesn't mean that we can't still use, a 1348 price opportunity here for, or the price opportunity we're talking about is being down 30 cents on the day, right? And 50 cents from highs. We can now use, a 1380 call, cost 40 cents. Okay, that's a lot of money to shell out for a call that would go in the money if we get up to highs. But, I'm talking about turning around and cutting that cost, down to 24 cents to own a dollar wide spread, 1380, 1480 call spread. Again, 40 cents out the door for the 1380 call, selling the 1480 dollar wide spread from here. It's 50 cents out of the money, is going for 24 cents. That's not terrible. I wish it was more like 20, but I think the volatility that we're seeing is starting to eat into and feed into some of these. So you can move that down and make it the $14, $15 call spread. Looks like that's going for about 23 cents. But for a penny and a half, penny more, I'd say bring that up 20 cents and go with the 1380s personally. But to each their own. But again, there's 113 days left on this. And if we're going higher, beans could be 14, 15, 16, 17, 18, $20. We might see $20 beans this year if we see weather events into this next planting season and through next summer. But it is certainly way too soon to be talking that. We still got to get through input pricing and, of course, pricing our acreage here into the new year. So let's move on here because we have got to get through some other stuff. Let's look at the meal chart real quick while we're on the beans, the topic of the beans, because I think the soy meal is an underrated chart right now. Started the year around 358. Old contract high of 408 was, in that summer, in that May time frame, early summer, late spring time frame. 314. 50 lows came in October after. So that massive breakdown in the meal while we were consolidating sideways in soybeans. The meal traded way lower down to 314s, and it's ricocheted off of support or whatever we came off of down here, all the way back up to a new contract high. And now turning the 55-day moving average above the 100-day moving average. So we just got that one of the golden crosses here. Going on. So the market is starting to push higher still and drag these moving averages above each other. So great to see meal trying to break out of its old contract high, kind of failing to do so. But there's still plenty of areas on this chart that I think it could hold support. And I want to bring up, because meal's actually been a pretty technical trade as of late. Impressively technical, actually. So I wanted to bring up the March meal 4-hour chart and kind of give you an idea of where I see now the 50% pullback. There we go. 392 is an area very similar to soybeans, how we pulled back. It's a highs to highs extension. 392 is where I'm looking for support there in the meal. It'd be hard for us to go down there and for soybeans to be at their support right now too. So I don't know. Maybe we just are in an even more aggressive flag. We can certainly find other reasons that there might be more aggressive support here, including pulled up the wrong this channel. We have this very aggressive channel, but channel support coming in here could be the reason that you justify the technical chart of why it's doing what it's doing. But it would, I think, it'd be healthier to see meal pull back to 392 and then continue higher up towards 420, and above. But c'est la vie. If they're all going higher, I'd be happy either way. So, all right, let's move on to the wheat. Chicago wheat here. Going through the Chicago, the KC, and the Minneapolis spring wheat pretty quickly. Chicago opened the year at 645. It then ran up pretty significantly to its contract highs of 874 in November. The KC wheat similarly started its year at 625. Off to the races, it went to contract highs of 892. So outpaced the Chicago contract there from a lower open to a higher height, and is now trading, at that premium to the Chicago contract. We haven't seen that from KC wheat in some time. And of course, last but not least, the big breadwinner, pun intended, was Minneapolis spring wheat, trading from 630 lows at the open of the year to 1066 and a quarter highs in November. The pullback we're seeing in Minneapolis spring wheat is down to test below that 55-day moving average. 100-day moving average is down around 962. 200-day moving average down at 863. You could certainly get down there, I think. And watch out, we are below that 18-day moving average. But okay, three-wave correction and a pullback, probably getting close to support. But watch that 962 100-day moving average. Kansas City wheat seems to be in a little bit more of a range here, $8 to $9 at this time. It is starting to find that 55-day moving average as support, but has been unable to trend above the 18-day moving average, which is usually that 18-day moving average. That red line is usually a good indicator when we're kind of staying above it and below it and moving along is when we're trending. Right now, we seem to be going on back over, trading on both sides of that line and not very trend worthy. 774 is where our 100-day moving average is. 717, that 200-day moving average, untested since last July. And of course, Chicago wheat, very similar to the KC wheat, in a bit of a range here, about probably the 760 to 820 area is where I'd call this range for now. It's testing its 100-day moving average down around 770, the 18-day at 789, and that 55-day at 794. The 200-day down at 727. I'm on the sidelines for wheat right now because of the sideways price action. I still would love to see it higher, and I think that if the row crops do continue higher, wheat will potentially be maybe be a laggard at this point because it was a leader before. It's kind of done its show, and we're really moving into a period in the cycle where I anticipate more news and more talk with outside of continued weather here for winter wheat and spring wheat, is more planning and acreage concerns for next year for the big row crops, and I think that's where we're probably going to see the market start to focus. So before we get live cattle here, I guess, opened the year 121.80 in the February contract, highs of 140.55 there. Bring up the right contract for us. There we go. 140.55 in the August high that we made. Then we had made our contract high there for 141.35 in November. 138 to 142 call spreads are actually what I've already kind of got on. I don't want to talk about a trade that isn't a new thing, but I'm just monitoring that trade that was put on actually over this last week. 138, 142 was just a call spread that we used to buy this dip. I'm still a buyer in the cattle. I'm bullish above 136 on them. So, but right now I'd be structuring for anything in a break above 142 is really at this point what would be looking for or be kind of gung ho about. Which, okay, let's look at an option right now. What is 142 calls going for? Even though I'm short the 142 Feb call, it's part of a call spread, right? So, the idea of buying the 142 as a just position, I really don't hate that idea. There are 28 days left, so you're not dealing with much time value left on them, but okay, for $1.30, that means you got to get to 143.30 to be profitable. If we're going to break out above that level in cattle, it's going to be a pretty significant breakout, in my opinion. So we'll see what happens from there. All right, and last but not least, let's talk about the hogs here. Lean hogs. Kind of have a trade idea because don't have much time to talk about it, I guess. But if you get cut off from our Zoom, of course, check out the recording or the Facebook Live that this has going, because that will go into the details of this bad boy. But the idea that I'm working with and kind of been thinking about is a strategy that will, hogs have every opportunity to break out here, but we can't deny the fact that we've been in this big range. So I wanted to structure a trade that if we really start to break out, and hogs want to break out up to 100 and 102 and higher, I have a position on that will give me that opportunity, but also, position for if we don't break out of this range and we stay in this range, generally stay above 83, or, just somewhere in this area, or stay basically between this 88 to 82 range that we've been in, that I still make some money. Which is kind of an interesting concept, right? It's almost non-directional. This strategy will actually make money all the way down to 83, then start to lose money below. Well, that's fine. We can take care of that and neutralize that by selling a future, or and having a stop in the market effectively. Or it starts to make money again infinitely above 90, 92. But it actually the only real place it loses money is in a little band here between 90 to 91, and of course below 83. So what we're doing to achieve that idea is, don't worry, we'll perfect. HE here. Yeah, perfect. Okay, so you can see down here, I've got built out the strategy. We would be you buy two of the April hogs. So I'm not even looking at. Uh, I was looking at. Oh, I guess we were looking at April pricing there. That's good. I had the April chart up before, but April hogs. So these give you. Those April hogs give you 105 days left on this option strategy. So there's so much time left. And like I said, this is a P&L curve now of what this strategy looks like. And so it's buying two of the $92 calls, spending 3 1/8 pennies on that, buying two of them, of course. So that's going to, come out to be 6 1/4 uh, dollars spent there. Then we're selling a $90 call and an 83 put, bringing in 405 and 340 respectively. All day, that is going to be a net credit of 1.2 or $480 per contract you do. The purple line is you can kind of ignore the purple line, but that's the net P&L of the strategy in real time, um, which it doesn't matter. What we're really concerned with, or what you should concentrate on here, is the blue strategy, because this is if you hold the option strategy, the blue line, to its expiration. This is how it would pan out for you. Basically, above 93 or 83 here, but below 90, you would make $480. You would make that credit premium that you brought in on the strategy. Uh, if you go above 90 and below, well, and below 92.80, you're going to lose a little bit of money, as much as $310, or just break even on the trade. Then above 93, though, things get interesting and you start to profit because of that long $92 call that you have. Below, however, 83, you start giving back that premium, and below 81.80, you actually turn negative. So before 81.80, you have to just make a decision on the trade and basically neutralize that short put, because that's going to start being a liability. But the $1.20 premium you brought in on the trade ends up, giving you a little bit of forgiveness there. Hence why your break even on it is actually right down there at 81.80. But keep in mind, it does have infinite losses. If we were to go down to 70, you'd incur a $5,000 loss on this trade. But that's why, this isn't being put out there as a set it, forget it type solution. You have to manage this trade. But it's interesting that there is a small gain no matter what happens in this big range we're in. And, but it's positioned to still make money if we break out to the upside. And of course, it's, very much a long side bias trade. But buying two of the $92 April calls, spending 3 1/8 there, selling one of the $9 calls, bringing in 405, and selling one of the 83 puts, bringing in 340, gets a net credit of 1.2, and sets you up with this. I don't know what we would call this. It's like a strangle with a call kickers or something. I'll come up with a cool name for it. Maybe I'll deem it my own name. But with all that being said, thanks for joining me here today. I hope everybody had a great 2021. I'm kind of glad the year is coming to a close and we get to start another one here in just a few hours at this point. But thanks for joining me. Remember, trading futures involves risk. It is not suitable for all investors, but everything I talk about here today is my own opinion and not a direct trade recommendation. But if you are interested in turning them into direct trade recommendations, or working with myself or any of our team over here at Zaner, feel free to give us a call at 312-277-0110. You can find me on Twitter, Facebook, or shoot me an email. Leave your likes and your comments in the section below. I'm Dan Hussey with Zaner Ag Hedge, everybody. This has been your Strategy of the Week update for December 30th, 2021, and our end-of-year review. I hope you've enjoyed the broadcast. If this is your first time checking out the Strategy of the Week webinar, be sure to sign up to join the mailing list to not miss any of these. These usually aren't posted. The Strategy of the Weeks aren't posted live. They are only for webinar subscribers. So feel free to sign up in the links below and in the chat section for those. Have a great day, everybody, and I'll be back with you as price action develops. Take care, everyone.